Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio Strategy and Management. And I would like to talk to you today about a very simple model to invest in the market, which is very good in providing profits in up or down markets. Our information is also available on www.peterdack.com, where you can subscribe to the Peter Dack Portfolio. The basic information I'd like to talk to you about is stocks and bonds. But again, to rationalize the relationship between these two asset classes, you have to think in terms of stocks as leading economic indicators. In other words, if they decline, that means the economy is going to slow down. If bond yields rise, that means the economy is strengthening. So I have other videos on the subject, but again, the important thing is to recognize that stocks are leading indicator and bond yields are lagging indicators. It helps you rationalize what I'm going to talk to you next. Then I will talk about the relationship between stocks and bond prices, which I think is absolutely incredible, in case you never thought about it. And then what is an investment strategy to make money both in up market and down market, that is in bull or bear markets. It is important to accept the idea that one invests in bonds for capital gains. They can provide superb profits. If you look at bonds, again, for capital gains, you have to forget about yields. That's important, but it's secondary if you want to make money with bonds. Then you have to focus on long-term bonds, and the reason is because long-term bonds appreciate the most for every percent change in yields. And then we are going to use the ETF TLT, which is the ETF for long-term treasury bonds, as a proxy for bonds. Now, to bonds, as for some reason people get tied up when they hear about bonds. I have a video, Business Cycle Bonds, is available on our website, www.peterdack.com. I recommend that you read it because bonds offer a great investment opportunity, as you will see in this short presentation. What is the relationship between stocks, bonds, and the economy? Again, I talked about this subject on business cycles, but that's why you have to recognize that stocks are a leading indicator, bonds and bond yields are a lagging indicator, and then of course the economy, which is a coincident indicator. Anyway, how are they all related? Again, if you have to understand the strategy, you have to. It's important to rationalize the strategy in this way. At least that's the way I see it. Stocks and bond yields decline as investors expect a weaker economy. In other words, if the economy is going to slow down, then you should expect that stocks will decline and bond yields will decline ahead of the economy. On the other hand, if you expect the economy to strengthen, then stocks are rising ahead of the economy and bond yields eventually will rise as the economy strengthens. So this is the basic relationship between stocks and bond yields. Stocks decline, then bond yields decline because the economy weakens. Stocks rise, then eventually bond yields rise because the economy strengthens. That's the relationship between the two. It's important to rationalize this if you want to appreciate the investment strategy. Again, you have to remember that bond prices rise when yields decline, and bond prices decline when yields rise. Again, I explained all this and the sensitivity of bond prices to yields. When yields decline, bond prices rise, and the increase is the most in price is the highest as the yields, the maturity of the bond is the farthest away. So the best price appreciation when yields decline is provided by bonds with very long maturity. Again, all this is explained in this video, Business Cycle Bonds, which is available on our website. Let's look at the stock market and how it behaves in an ideal way. The stock market rises because, again, you can give many reasons. The economy is strengthening, profits are stronger, the Fed is easing. But there is a point where the stock market tops, and any important top lasts several months. That's an important thing. It doesn't important market declines like here, they're always preceded by a substantial period of several months of market going nowhere. Then the market declines, there is a substantial decline in the stock market, and the more the market declines, the longer it's going to take for the market to found a base, a bottom. Then the next cycle starts and the market goes up again, as in here. So strong economy, the market peaks several months, sharp decline, the economy is likely to slow down, then there is a basing of the stock market. Once it finds the bottom, eventually the market keep going up again. Okay, let's see now how all this relates to the bond market. Then we'll put it together and you will see it's an amazing relationship where you cannot fail but just make money. Okay, this is now the stock market and bond prices when you put the two asset classes together. Now what you see is that when the stock market goes up, the economy strengthens. So you expect yields to rise and therefore bond prices to decline. But when the stock market starts bottoming out, means that the economy or investors expect the economy to slow down, or maybe the stock market is just overbought. So there is a long period of topping base. What you see on the bond market is that the bond market stops declining, bond prices, and then eventually responds to the belief of the stock market that the economy is slowing down. So what you see is bond prices rise as stock prices decline, because again, the market is expecting a weaker economy. But as soon as the stock market bottoms out, okay, that means that now the stock market is saying, wait a minute, maybe we overdid it. The economy is not that bad, so let's see what happens. So the stock market bottoms out. This is when bond prices stop rising and say, wait a minute, the stock market is telling that the economy may be stronger, so let's not get carried away and get yields too low and bond prices too high. And then sure enough, the stock market goes up because they expect a stronger economy ahead, and of course yields respond to this increase in the stock prices by going down. Now this is simple enough, but there is a little more subtle relationship here that I think you probably want to pause this video, take a glass of water or a cup of coffee or a scotch, because I'm going to get into a little more detail. Okay, how do we increase the probability of always being invested in the right asset class? Well, what this chart is showing, as you can see, all the arrows at different length. When you perceive that the stock market is not going anywhere, this is the time you start investing in bond. And you be invested in the bonds because bond prices go down. And then, of course, the stock market doesn't do anything. You're still invested in stocks. The market bottoms. So when you see the market bottoming out, that's the first sign that maybe the rise in bond prices is overdone. But wait a minute, don't reach conclusions. What you have to do is wait for the stock market to go up. That's where things are getting really easy. Because if you wait for the stock market to get a nice rally, then you know that you have to sell bonds because bond prices are going to decline. This is where we have developed at Peter Dagan Associate some models to time this phase here and this phase here, this phase here and this phase here. So the bottom line is you're always invested. In this phase, you invested in stocks, but then you switch to bonds. Here you switch to stocks and you get out of bonds. So this is a way of profiting in up or down markets. Okay, this is the way the relationship works in real life. This is the stock market, the S&P 500, the solid line, up, then tops, down, bottoms. You see, it takes a couple of 2 or 3 months to bottom, then rises, then there is roughly 1 or 2 months of a top, and then goes down. This is the TLT, which is the Treasury long-term, the ETF for the Treasury bond fund, 20 years, you see 20-year plus. So it's a very long-term bond, which is what you want, because when yields decline, then the prices jumps up. So, and this is the price of TLT, goes up, then goes down, then goes up, it peaks, goes down, and then rises again. Now look at the relationship is, you know, when one goes up, the other one goes down. When one goes down, the other one goes up. When one goes down, the stock market goes up. When the market tops and goes down, TLT goes up. The market here bottoms out. You see it bottoms. And then TLT tops and goes down as the market rises. Now look what happens here. The market here tops and TLT goes up. But again, it's more subtle than that. You can increase your odds of making money if, as I said, take a glass of water, whatever, but just there's another interesting relationship here. You see here, when the TLT stops declining, is a warning sign that we are close to a top in the market. So when the market goes down, you should already been invested here a little bit into TLT. Then when it declines, you start investing more aggressively. Now, when do you get out? Well, you get out after the market moves up, because after the market rises, clearly this is a bottom, look how strong it is, then you can get out here out of TLT. Look what you have the odds of getting out of TLT after a strong rise in the stock market. Then look at what happens here. TLT stops declining. That is a sign that the market is close to a top. And then TLT start rising. That's even sure that you bet that the market is at a top, so you get out of stocks and getting into bonds. And you get into bonds and you ride all the way. The market then declines, confirming that you have done the right move. Then it bottoms out. But stay in bonds, because you see, bonds don't go anywhere. They are in a bottom topping phase, but they don't decline until when? Until the market shows that really there's a big jump. Look, from here to here. Then bond prices decline. Then they stop declining. That means the market is at a top. Then shoot up as the market goes down. So obviously when you get out of bonds, there is plenty of time, because what the market has to do, like here and like here, has to bottom out, rise, then you get out of TLT. In the meantime, you might have chances of capital gains plus the yield. Now, obviously, what we have developed now is models to understand if we are here and here, both in the stock market and in the bond market. But as you can see, you can ride this thing through, and is a classic, beautiful model to, again, as I promised you to show you, to profiting in up or down market by just moving slowly your money from stocks to bonds. As I said, it helps to have timing models to increase your odds in calling a top or a bottom in both markets. And again, the idea is to move slowly from stocks to bonds, but you always have this process, dynamic process, continuously that takes you into the strongest of the two asset classes. I want to thank you for reviewing this video. Hopefully you'll find it informative. And again, if you want to subscribe to the Peter Deck portfolio on www.peterdeck.com, we review this information all the time, and of course we are money managers as well, so that our clients take advantage directly from our view on both markets. Again, thank you, and I hope to see you really soon. So long.